In this video, we are going to cover the PUA rider, term insurance rider, and then how the MEC limit works. The purpose will be to take a whole life insurance policy and start with a very basic overview, meaning what do most people see when they are presented or proposed a whole life insurance policy, and then show you how to reverse engineer the policy and really maximize the cash value. And this hopefully provides an understanding, one, of how the product works, but two, awareness on the different components of a whole life insurance policy, and equips you with enough knowledge so you can ask the right questions when you're working with an agent and get a policy that's set up for maximum cash value. So the next term we have is what? PUA, which stands for Paid Up Additions Rider. This is a good thing to attach to a whole life insurance policy because you see more of your money available right away, long term. It's how you maximize the cash value. So what this does is if you add money into PUAs, let's say it's $10,000, nice round number for now, that purchases you paid up additional death benefit. The term stands for paid up additions, meaning if you were to throw $10,000 into this PUA rider, what would happen is you will see an immediate benefit with the cash value. I'll touch on that in a second. However, what you'll also see here, let's put this in orange, is that it will purchase you additional life insurance, additional death benefit. This will depend on your age, product, a couple other things. However, if you pay in 10 grand, you might see another $30,000 show up in death benefit. And why the term paid up exists is because PUA payments are optional. They're very flexible. You can elect to make those payments or not make those payments. The dollar amount can vary each year, but once you make the payment, it does purchase you additional death benefit and it's paid up. Unlike a base premium that will be billed for the life of the policy, where each year they're going to say, hey, here's the bill, please pay it, or elect the option where you don't have to pay it. But a PUA rider, because it's optional, once you make the payment, purchases you paid up additional life insurance, meaning no recurring premiums. And if you decide to add more money into PUAs, it'll purchase more paid up additional life insurance, more death benefit. That's an automatic value add. Why I add that is because we'll still get the comment there, well, I don't care about the death benefit, I want the cash value. With that option, the one I just mentioned where it purchases you paid up additional death benefit, that still maximizes the cash value. So PUA payments, what they do here is always maximize the cash value. So let's put this in blue. So PUA payments will show up in cash value immediately minus whatever the initial fees are. So you will see PUA fees associated with whole life insurance products. The majority of PUA payments, however, net will show up in cash value immediately. It will depend on the company's PUA fee. On average, if I make a $10,000 PUA payment, I'll see anywhere between $9,000 and $9,500 immediately show up in cash value, somewhere between 90 and 95%. And then remember, as the years pass, you start to receive compounding, the guaranteed rate, also dividends, which will quickly overtake that fee. And when you look at a life insurance illustration, both the cash value, both on the guaranteed side and non-guaranteed side, will reflect the PUA fees, the base premium costs, and all other charges with all other riders. So that net cash value column, that's your money column, if you want to follow the money there. Now, here's a very important piece. PUA payments will result in the highest guaranteed cash value. What that means, so going back to the base premium, what did that do? That resulted in the lowest guaranteed cash value. PUA payments, highest guaranteed cash value. So if you are really examining a policy and trying to figure out which one gives me the greatest guaranteed values, like how do I get the strongest overall guarantees? What you will find is a policy that has a minimum dollar amount, minimum percentage of your total payment going toward premium, and the maximum toward PUAs that will give you the highest guaranteed values every single time from everything we've ever seen forever. And then when we look at actual policy performance, the same is true there as well. And then this is a big one, flexibility. This will depend on the company. So what I mean when I say flexibility. So going through a lot of information here. Where did we leave off in the last page? We talked about that $20,000 payment. Let's loop back there. So if you want to be able to pay in $20,000 per year, and let's say we put 10% toward the base premium, that's $2,000. So you've got $2,000 toward the base, and then we just talked about PUA and flexibility. So what that means is exactly how you can add money into that PUA rider. This will depend on the insurance company and also the product design. This is very important. So to provide one example, there's a lot of companies out there. If we take, let's combine both company selection and product selection. Let's take Guardian. Their logo is green, so let's draw them in green here. One of my favorites of the major mutual companies. So you can have a design like this where you've got a $2,000 minimum premium. But when it comes to the PUA rider, they will allow you to add funds into PUAs 100% at leisure. So what that means is if you've got a $2,000 premium and you wanted to add, let's call it, for simplicity here, another $18,000 per year, that additional $18,000 can be added all up front. You can pay at the same time as the base premium. That additional $18,000, you can add another $1,500 per month. That additional $18,000, you can add $3,000 here, $5,000 here, and gradually work your way up to $18K. That additional $18,000 might not even get into the policy. Maybe it's another $3,000 that you add. My point is that, again, it can be added at leisure. It's extremely flexible. So Guardian offers that PUA flexibility. However, product design is another thing to be aware of. When it comes to product design, all right, so with Guardian, whatever your base premium is, with respect to PUAs, for a $2,000 base premium, you'll see during the first 10 years, they will allow you to pay whatever that base premium is, 3x that dollar figure in annual PUAs, which comes out to another $6,000 per year. Add the two together, you get $8,000. However, we talked about product design. If we attach a term insurance rider, specifically what is referred to as a one-year term rider, guess what happens to those PUA limits? It's not 3x. As long as the term rider is attached, so let's go like this, with OYT, stands for one-year term, now all of a sudden, you can go 10x the base premium in PUAs. And the first year is actually 50 times that. That's with or without a one-year term rider, that 50x. But 10x is the maximum. We can illustrate that. We can't go any higher than that in the software. So what that means, a $2,000 base premium. You can illustrate another $20,000 into PUAs. Add the two together, a total of $20K. So product design is very important there. If someone's interested in a minimum premium, maximum PUA policy, which will maximize their cash value, I know I want to attach that rider there. And of course, if I wanted to understand how that rider works, we've got videos that provide a full breakdown on that, because with that rider, some people, my peers that is in the industry, do not like it. I'm a huge fan of it because corporations use it, but again, transparency is important. So a lot of information here, but when it comes to the PUA rider, maximizing that will maximize the cash value. Now, we've got this guy, the MEC limit. So bear with me here. We'll stay with that $20,000 example. The MEC limit is very important. MEC stands for Modified Endowment Contract. And in short, we look at our third cash value benefit, tax-free. If you have a cash value life insurance policy and it's not a MEC, you can access that cash value tax-free through loans all day long. Say all day long throughout the life of the policy. If your policy becomes classified as a MEC, what happens is we have to deal with taxes. Specifically, with respect to the gains, anything you access, whether it's through a withdrawal or a policy loan, if you access it, you've got to pay ordinary income tax on the gains. And if it's before age 59 and a half, you've got to deal with potential 10% penalty tax. We don't want this to occur. It ruins everything. So how we prevent it is every policy has what is referred to as a MEC limit, which is exactly what it sounds like, by the way. It's a limit that determines the maximum dollar amount you can add into a policy each year and still have the IRS view your policy as life insurance and reap those tax-free benefits. Not this MEC, where now you have to deal with taxation on the cash value if you want to access it. The death benefit, by the way, with a MEC is still paid out income tax-free. So this MEC limit, here's the fun part. We can set it wherever we want. How we do that is you'll find that it has a direct relationship to the death benefit on a policy. Now that's not the only factor. Our age, gender, guaranteed rate, that'll also have an impact on the MEC limit, so the product we select will. But the biggest factor is that death benefit. So when cash value is the goal, we'll design a policy for the minimum death benefit that's needed in order to pay the desired dollar amount. Example, I want to fund $100,000 per year. I need a MEC limit of $100,000. In order to attain that MEC limit of $100,000 based on my age, I need this wacky death benefit of $2,050,000. Why not a clean $2 million? Because that gives me a MEC limit of $98,500, and I want to be able to pay in $100, so I need a little bit more life insurance in order to get that MEC limit of $100K. So now I can pay in $100K and still have the IRS view my life insurance policy as life insurance with the tax benefits. So a lot of info there. How's that all tie to this? How it ties to it. The base premium does what? Purchases you. Remember the first point? What has a direct relationship to the MEC limit? The death benefit. So where that's important here is if I go with the policy that looks like this, $20K in, but $2,000 toward the base premium, and say $18,000 toward the PUA rider, cash value will look pretty good. However, I would find in a policy like this that my MEC limit is only $6,000, which would immediately trigger a taxable event. So to provide one more data point here, that base premium might get me a death benefit of $100,000, where I need a death benefit of $500,000 to attain that $20,000 MEC limit. So how do we do this? Because we can raise the base premium, but then we'll go backwards. We don't want to do that. So how we do it, ready for some fun, is through a term insurance rider. What this does is it buys you additional death benefit. If again, you're thinking, okay, I don't care about the death benefit, I want cash value. Think of it this way, buys you additional MEC space at a very, very low cost. Cheap way to raise the MEC limit. Now the term rider is a cost. It does not build cash value. But again, by buying us more life insurance, it has a relationship to the MEC limit. There we go, cheap way to raise the MEC limit. And there are two types of term riders that exist. We've got a level term rider and then a one-year term rider. Our company uses both of them depending on your situation. A lot of times when we go back to product design, that one-year term rider will often open up a lot more flexibility. PUA limits increase. When I say flexibility, being able to add more money without underwriting. A lot of corporations use it. But a level term rider works. A lot of times you can combine the two. So to summarize everything here, what we can do is this. $2,000 base premium. Age will have an impact on this. It'll likely be lower than $1,000. It almost always will with $20K per year, but let's call it $1,000. And then $17,000 toward the PUA rider. That additional term insurance rider, so let's say the base premium here bought me a death benefit of $100K. The $1,000 term rider, though, bought me another $400,000 in life insurance. Add the two together, I'm at $500K. PUAs will also get you some death benefit, so $17K. That might get you a little bit less than $60K. My point is, when it's all said and done, that term rider did this. Got our MEC limit at or above $20,000 and allowed us to minimize costs and maximize this guy, getting more money into cash value. And the difference will be here. first year is where people will feel it the most. Instead of a 0, I paid the same money into the same whole life insurance product, just designed differently, and I've got $17K. Second year, another $20K, and I've got $36,000 instead of 0 to 1,000. By the 5th year, I see that I'm in green because now I'm equal to in cash value what I've paid into the product. Meaning you've paid in 20K for 5 years, that's 100 grand, and you have 100 grand. By the 10th year, you're at 230, year 15, you're at 400, which is another $100,000 than the example without PUAs. And you can look at examples with a 50% premium, 50% PUA, it'll fall in the middle, but generally what you will see is the lower the premium, the lower the expenses, the more money I can direct toward the PUA. I can also make it very flexible because I'm only committed to this. So this way I can commit to the minimum and dump more money into the product at leisure. Hope you enjoyed this video with the additional information. I love going through this stuff. If you have any questions, please leave them in the comments below. If you like this video, please hit the like button and subscribe for more. And as always, I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.